Hey everyone, it is Evan here from the Trade Risk on Friday, March 20th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So my goodness, what a week for the record books. The numbers here, just looking right off the bat at the 5-day change numbers for the major indices here, 17.5% for the Dow, 14.8% for the SPY and IWM. And this is after two already brutal weeks, three, in fact, brutal weeks of selling prior to this. I mean, these numbers here that we're looking at on our dashboard are all 5-day performance numbers. This would be considered a horrible year, let alone a single week. So it goes to show you that this is absolutely unique times. I've got to imagine this is going to be one of the worst looking technical dashboards here in terms of performance, negative performance that we are going to see across decades. In fact, I mean, this is just a really brutal week and time in the market for selling. So lots to cover. I got lots of points here that I want to touch on, and hopefully I can do it without jumping all over the place. Let's first look at just the dashboard here. Again, like we talked about, it was a rough Friday here, down anywhere from 2 to 4 or 5% in the indices. Most of that occurring at the last half hour of the day. We had a lot of option expiration going on today, but 5-day change numbers, of course, horrendous. We're below all the simple moving averages for the major indices. And if we look here at just the 5-day performance of sectors, it is just a sea of red here. Biotech, staples, healthcare trying to outperform, but it's fairly laughable at still being down 10 and 12% for XLP and XLV. On the downside, on the underperformers, yes, it does get worse. Energy, once again, 20% down, followed by industrials, followed by financials, all almost 20% down. In terms of major markets here, now this is the very interesting thing, or one thing we're going to touch upon, is just the VIX is finally seemingly stopped just going totally vertical, up only 13%, which, when you look at these numbers and then you see a VIX that's only up 13%, that should send some type of signal or alarm or, reason to investigate. Part of that reason is, of course, because the VIX is so extremely elevated. We'll talk about that in just a moment, but 14% over the 5 days, TLT and the US dollar top 3 holding green. On the downside, oil plunging again, 29%, followed by natural gas and silver. So let's jump into the charts here with the S&P 500. This is a weekly time frame chart, and we're looking at the cash settled market for the S&P 500. So we just experienced basically 4 weeks of brutal selling here, and this was the largest week down now in this series, down 14.28% for the S&P 500. And you can see now we have finally broken below. We've certainly tested it, and tested as in the sense of now breaking below and closing below the 2018 pivot lows here for December, a level that I certainly was looking for. I think lots of people were looking for the market to get a good test of that. It happened, in some of the after-hour session, but finally we got it on a regular trading hours test here, and we are currently closing below it. Now, if we go to, let's just go to a yearly chart here, just for fun, of the S&P 500. I have most of my boards in use. Let's see if I have anything clean. There we go. So if I look here at board 7 now, we see the S&P 500 on a yearly basis is undercutting and has completely negated all of last year's progress. So remember, we were up 29% last year. It's basically all gone, and we are trading now at essentially levels seen in 2017, and in a few more percent, we'll be back to levels seen in 2016, 2015. In the S&P 500. So a pretty ugly looking yearly chart right now. Of course, plenty of months left in this year, so let's not get hung up on it, but just wanted to show the big picture there of kind of what we're looking at. And if we go back down to the weekly chart, and I try and throw on this view here. Let's talk about certainly the, let's try and divide this to the bearish arguments, the bullish arguments, right? So the bearish arguments, of course, is just that this market continues to struggle to find its footing. It has lost a third of its value in just 4 weeks of time, a drop, and it's in a speed at which we have basically never seen before. I mean, we've seen it in prolonged bear markets, and of course we have 87, and we had some nasty drops in prior bear markets, but again, the speed from which we're falling from all-time highs, from a life is good scenario to a suddenly, oh my God, everything's at 52-week lows, that is something that is quite remarkable. So the extreme technical damage, the uncertainty is still out there. Of course, this is driven by the pandemic, this virus that we're trying to get a handle on and understand just how bad this really is. There's lots of uncertainty out there in the market. Hates uncertainty. So, that is sort of what we're dealing with here. So it's a sell first, ask questions later. And we're seeing not only just the actual selling pressure here in the stock market, but we're actually seeing and have experienced lots of concerns in the credit markets. So we've seen lots of very disturbing trading activity and pricing in the credit universe right across the board, from investment grade to junk bonds. We're just seeing dislocations and stress in the financial system, and that is not good. And that just, continues to exacerbate the landscape that we're seeing here in equity land. So, for all those reasons, that is certainly why we have a 1/3 haircut in the market in basically 1 month's worth of time. Now, if I flip it over to the bullish scenario, right? Let's try and get constructive here. Let's try and frame out some levels. And there are actually some things we can hang our hats on. First off, it's going to be nearly impossible to try and catch the exact bottom, right? We need to think in terms of probabilities, and we just want to be, as traders, at least the way I see it, want to be trying to transact, in areas of high probability, right? You're not going to get the exact tick low, or at least I think that's kind of foolish to strive for. But if we start to kind of frame out some potentially bullish scenarios here, again, speaking now as a short-term trader, if you're looking to catch the bottom, if you're looking to try and establish some type of swing trade here to the upside or some reactionary bounce, right? This is the audience. This is where I'm speaking to now. So first thing is, of course, more extension down is a good thing. So the band basically after this week has gotten more stretched to the downside, and that sort of sets us up. Of course, the farther that band gets stretched, the more likely it is, the odds increase in eventually getting that snapback, right? So another new sort of record since 2008 on a down week is a good thing for setting us up for some type of potential of a snapback rally. So that's the first thing that we saw that was good. The second thing here is if we go to the daily chart now of the S&P 500, what we saw this week was the majority of selling came on Monday. It was with the gap down on Monday. That was a 12% down day, a huge down day for the market on Monday of this week. And what you'll notice is after Monday, see if we can clean this up again. So after Monday, we really kind of compressed here in range. Now, of course, ranges are still very wide and historically elevated, but just notice that, we started to go sideways here and overlap quite a bit in the S&P 500, basically in, most major market, other indices as well. So that little range compression there is finally some signs that the selling has slowed down in its pace. So that's a little bit of, again, a slightly bullish sort of check mark there. Again, very loosely speaking. Another constructive sign here, third thing, is that yes, we did totally, kind of capitulate into the close here on Friday, but notice we stayed above Wednesday's lows. So the S&P 500 did not close at weekly lows. It didn't make new lows into Friday. It is actually still trading, in fact, above. Let's go to the SPY chart, because usually this is a little bit better, or more updated, I should say. So we are below Thursday's lows, but we did still manage to hang on to Wednesday's lows, a slight positive there. Finally, if we look at VIX here, VIX on a daily chart, you can see trading down around 65. I don't know if that's the settled number yet, but trading around 65. That is off of the highs. So we have the S&P 500, which is pushing to new lows here. We have the VIX, which is off of its lows. So again, just goes to show you that it's going to take extreme fear to really persist here. To keep the VIX elevated at 70 plus is a feat in itself. It's amazing we even traded 4 or 5 days up there in a row. So to keep that same level of fear, it's going to take some extreme events and a lot more panic, and unfortunately would be much worse headlines, which hopefully we don't see. But the VIX, pulling off a little bit is another subtle sign. So all of that to say, we have some signs of stabilization here. We have some signs that the market has, started to maybe get ahead of itself. Again, I'm not trying to call a bottom. We could easily gap down on Monday if we have more news stories and this virus continues to go parabolic in its spread, then certainly all bets are off. We will continue lower for sure. But I'm speaking again to those active traders that are looking to potentially position, looking for some signs of, a change of character, so to speak, in the market. I think you do have some subtle changes. Last but not least on this list is we are seeing liquidations here. We're getting news stories of some big funds that are closing down shop. Unfortunate to say, but we are liquidating in some of those funds, and those numbers, I'm sure, and those stories will continue to break over this weekend. So again, for a capitulative sort of environment, I think you're starting to see signs of it, at least again for a short-term bounce. Again, risk management, of course, is paramount, and you need to be very careful there. I'm absolutely not saying, hopefully, understanding that it is not okay, let's buy, these are a bunch of bullish developments here. You have to be very considerate, and this would be for experienced, advanced traders, so to speak, only. So that's sort of the thoughts there in terms of markets. Again, last thing, if I throw on this view again, which I think has my levels here, for you traders that are looking for a little more patient or even to catch this bounce, I think these are the relevant levels here in the short term that we would want to start closing above. So frankly, 2346, this very bottom yellow line on my chart, that is the lows from 2018. Getting back above there and holding the 2018 lows, that's going to be important. So that would be the first most aggressive sign of where maybe you could start to layer in. Again, I hate to speak in specific trade terms because there's so much unknown right now, but 2346 would be the first line, 2380 the second, 2440 the third. Those are essentially the levels I would like to see this market start to reclaim above. If we can get a close above 2440, if we can get a push above that area, I think we're in store for that multi-day sort of reprieve bounce up to, the 2800s or so. But again, one day at a time, just trying to pick the tactical levels there because I've had a lot of questions come in on some of the short-term levels. Longer term, of course, stick to your plan. This is a extremely risky market environment. So for our strategy that we are primarily trading, or certainly I'm primarily trading and have most of my capital invested in, the Merlin trading strategy, that has basically been 80% cash now for some time. We have some staples and some healthcare exposure on, but it's basically being sidelined here. That is not looking to try and catch a bottom, and that's essentially the way I'm playing the majority of my cash in that fashion. So that covers, I think, the major markets here. I think all of the others here, I mean, IWM, we can go right down this list. Everything's going to look pretty much slaughtered here. The other sort of encouraging thing, this was another bullet point, was the Russell 2000. Notice here that this, in fact, has a different pattern here, but it actually had a 4% up day yesterday on Thursday, which was outperforming the market. And you can see it actually outperformed here on Friday as well. So this was leading to the downside. It's starting to stabilize perhaps a little bit earlier, which is, again, gives you another little check mark there for the potential short-term turnaround, at this general area in the market. Last but not least, the Qs. Qs continue to hold up best on a relative basis. Still is not immune to the selling, but again, as we talked about in the midweek video here, let's just go to another board, take a look at where the Qs are right now. We're just back to essentially the, I guess we're undercut now, but we're essentially back to the summertime levels or June levels of 2019. So again, if we throw on a yearly chart here, And we take a look at the Qs here. We're down 20%, and we've basically retraced about a little over half of last year's gains. So again, a much more bullish scenario here. If we look at Qs, again, still just essentially riding up this uptrend here, and essentially looks like business as usual for the Qs as it's been marching along since the 2009 lows. So that's the NASDAQ 100, continues to look best in class. Now, if we start to get into some other major markets here, we'll go to TLT, which saw some historic moves. I think basically on all counts, we saw swings here in the TLT that I believe I can say we have never seen before in history in terms of the magnitude of these moves. These are massive up and down moves here for TLT, 6 and 7% on a daily basis. We finished off 7.5% to the upside on Friday, 3.5%. Look at the tail here on this weekly range for TLT. It's certainly extraordinary and historic. TLT, though, did manage to close green and save face and not close down here around 140, totally giving back all of the prior month's gains. So TLT bulls continuing to hold this up and at least weather the storm here. If you manage to sit through this, then you did manage to close higher here and stick within your trend. You can look at virtually most of the bond funds are all going to have pretty historic moves this week. TLT certainly exaggerated. If we go to metals next, we take a look at gold. Gold here, switch over to our other board. We might have this annotated a little bit better, but yeah, this 136 level, 137 level, if you recall from last week, this was really ugly action here in GLD last week, 9% bearish engulfing week. We got follow through to the downside. Bulls did step in here right where they needed to, so technicals kind of, telling the story here, driving a little bit of the narrative in the sense of dip buyers coming in right around 137 where they did in the fourth quarter of 2019. That is constructive. That's a good line in the sand for gold to try and hold. Does seem to be sort of range bound here. At least that's the way I would consider it. Long-term uptrend, maybe you could still consider higher, but intermediate term kind of moving sideways here. Midpoint of control coming in right around here. So that's the way I would frame out gold. Looking to stay above 136 is ideal. And silver here on the week, down 15%. Huge move down for silver. Certainly off of the lows, high volume coming in, but we totally, as we talked about in our midweek video, broke down from multi-year support here around $13. So this is in a very difficult spot here. Not interesting to me whatsoever. Sellers in control, can certainly bounce, but just really not all that interesting. Now, if we get over to the energy market, USO having basically a new sort of record week down. We were down 20% last week, which I don't think is a record, but certainly a record in recent history. And now, of course, this week we're down 29%. So continued to see just a difficult situation on oil on both fronts, on the demand side and the supply side. Really just not just painting a very bleak picture here. Again, might be overstated on some levels. I'm sure the dip buyers and value guys are going to be looking at this and potentially trying to stabilize and look for rebounds here. There's opportunity, but it's essentially broken as far as I'm concerned to the downside right now. Really, again, not that interesting in my book. Natural gas, on a relative basis, holding up pretty well. I mean, it's quite contained in a lot of sea of chaos here. You could look at natural gas and saying this is one of the most orderly products that's being traded right now. Even including equity markets. Obviously this is in long-term downtrend, so there's nothing to really like about it from a long-term perspective. But over the short term, who would have thought that you could have, put money here in natural gas and have this sort of orderly here, especially if you're volatility adjusting, because I mean, these are still big moves, but natural gas, closing here back below this level certainly, doesn't look good in the short term. But as we've said, over 13 as it continues to stay in this sideways range and then ultimately above $15, that's what it's going to need to, really start to take off and maybe perhaps lift to the upside over the intermediate term. So that I think covers all of the markets there. Let's go quickly through some of the sectors now, the sector analysis. So we'll look at the top three, bottom three. So if we look at the top three here, both So IBB and XBI here. So this is our biotech sectors here in the market. They were the best performing, down approximately 5 and 8% respectively, IBB and XBI. You can see here on a weekly chart for IBB, back down to the lower end of this range. There's really not too much to like about it. From a technical perspective, you can make a bunch of cases here that we're at the lower end of this range. So there's some value down here, especially if you're looking over the past couple of years. But still, it looks, it looks to be quite messy, and on a just generally speaking here, no real trend to speak of anymore. It is pretty broken to the downside here. So XBI back to levels seen a couple of years ago. Same for IBB. So, if you're interested in value there, there's some opportunity. Number 3 here is XLP. This is Staples. This was holding up decently on a relative basis. I think it still technically is if you take the entire magnitude of moves here. I think XLP still ranks above, one of the top sectors. We do still own this here. So in our strategy, we do still have the limited equity exposure that we have. We do still have it in XLP. It hasn't stopped us out yet. So we do own this. This is a daily chart for XLP. It still looks like a fairly, a fair nightmare here, or a mess. It's coming back down into the 2018 lows. So again, when you think of it in a relative basis, it hasn't quite broken from last year's lows. It's holding above last year's lows. It's coming back to the bottom end of this range. So, again, on a relative basis, it is holding up. And then last but not least here, looks like Staples are not Staples, XLB, this is materials, is the technically the third best relative strength performer here, still down 12.5%. You can see, though, lots of consolidation here for materials. So again, you can see, as one of the themes we talked about there at the beginning, a little bit of price compression. That's a good thing for markets. Doesn't mean it can't take another leg lower, but good price compression there in XLB. We'll see how that resolves next week. Looks pretty explosive. On the downside, energy. Energy here, really nothing new. This has been on the downside. It's been underperforming. It continues to underperform. It is probably at all-time historic oversold levels, but doesn't mean, it has to stop or snap back now. Certainly, though, dip buyers, value guys, I think, are looking at this sector closely here, trying to figure out what's worth dollars and what's, unfortunately going to go bankrupt. That's sort of what we're looking at here in XLE, but continues to be extremely stretched to the downside. XLI, second worst performer this week. Again, you can see on a monthly chart, take a look at just how far this has fallen. This is the 2018 pivot low here. We've basically, cut through that, and we're all the way back into the range here from 2013 all the way to 2016, that big sideways range in industrial. So really moving back multiple years here, setting multiple years back in XLI. So this is certainly suffering. And then finally, financials. Same thing, totally blew past, cut right underneath that 2018 lows. We're back to that 2014, 2016 range. So again, extremely stretched to the downside, but still continues to be essentially the leaders to the downside in this market. At some point, value, reversion, some type of dead cat bounce is going to happen. Maybe it's Monday, but you got to be careful there, and they still tend to be the worst performers of the group. So that's it. Long market recap, but my goodness, what a lot of movement and headlines and uncertainty out there, and markets are reflecting it. We're down again 1/3 in about basically 1 month worth of trading, historic by any measure. So hopefully you made it through the week, and hopefully this video is helpful. So enjoy the weekend, get some rest. We'll be back at it on Monday. I'm sure it's going to be, again, another very busy week. So thanks, as always, for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend. We'll see you back here next week.